This is one of the best businesses in the world. Intuitive Surgical, the dominant player in robotic surgery, has had huge success with its Da Vinci system, and the stock has increased almost 19,000% over the last 20 years. At the latest price, the company's got a valuation of $162 billion, with almost $8 billion of cash on the balance sheet and no debt. Meanwhile, the company has reported 7.6 billion of revenue over the last 12 months, 2.1 billion of net income, and 420 million of free cash flow. Intuitive's numbers look closer to a good software company than a medical business. Gross margins are strong at 67%, with EBITDA margins of 40%. Over 80% of total revenue is recurring, and the company continues to put up solid growth. The instruments and accessories segment, which is mostly recurring revenue, continues to grow in the high teens. And there should be plenty more growth ahead. 2.6 million procedures are likely to be completed this year with Intuitive Systems, but management thinks that number can grow to over 20 million over the long term. Of course, just because this is a great business doesn't mean that investors should necessarily buy the stock, and the big problem here is the valuation. Based on the last 12 months, the company is trading at 78 times earnings and just over 20 times sales. Among companies with a market cap over 100 billion, only ARM Holdings and Nvidia have a higher price to sales. And it's worth noting that Intuitive's free cash flow margins have declined in recent years as the company has been investing in new facilities and manufacturing capacity. Trailing 12-month free cash flow is now lower than the company's stock-based compensation. So investors need to be confident that Intuitive can maintain its growth and profit margins for many years into the future. But like any company, there are some risks to consider. Medtronic and Johnson & Johnson are launching their own devices, and Intuitive management has called out sharp competition in China. Regional governments there are giving preference to local manufacturers and putting price caps on surgical procedures. And not everyone is happy about Intuitive's monopoly status. To be fair, valuation and competition issues have been around for years, and Intuitive Surgical stock has continued to move higher. The company clearly has a wonderful business with deep relationships with major customers. Even AI could benefit the business given its data advantage over rivals. But in the end, Intuitive's valuation of 78 times earnings creates an extremely high hurdle to overcome, which is why I give the stock a neutral rating. But these are my personal opinions, not financial advice, and I hold no position in Intuitive Surgical. For more investing videos, make sure to